Welcome back, everyone. We're going deep today. Our topic, The Intelligent Investor, the classic investment guide by Benjamin Graham.
A true class.
We'll be pulling from the book itself. Plus, we've got Jason Zweig's commentary to add even more insight. So get ready. It's time for some timeless investment wisdom.
Timeless is right. You know, it's amazing how relevant this book still is. I mean, think about it. The Intelligent Investor was written decades ago.
Right.
The financial world has, well, transformed since then, to say the least. But here's the thing. Graham's core principles, they haven't aged a day.
Okay, so let's start with the man behind the masterpiece. Who was Benjamin Graham?
Well, he wasn't just some ivory tower theorist.
Right.
Graham lived it. He started as a Wall Street clerk and worked his way up to running his own investment partnership. That's real-world market experience.
I read a story about Graham making a 250% return on a stock, like in a single day.
Wow, 250% in a day?
Yeah, then boom. Just a few months later, that same company, total fraud.
Oh, wow.
Yeah.
That experience really shaped him. It taught him a harsh lesson about market hype and how absolutely crucial it is to do your own thorough, independent research. And he was known for that, you know? His analysis was incredibly detailed. He was like a scientist examining stocks under a microscope.
So that brings us to his definition of an intelligent investor. What does that even mean, according to Graham?
It's not about, trying to perfectly time the market or chasing the hottest trends.
Which everyone seems to be doing these days.
It really is, yeah. But Graham, he was all about thorough analysis, protecting against losses, and aiming for adequate returns, not necessarily extraordinary ones.
That almost sounds, well, counterintuitive in today's world. Everyone wants quick profits.
I know, right. That's why I think Graham's work is so valuable. Even now, it's a framework for making sound decisions. Even when, well, let's face it, even when the market is driven by fear and greed.
To illustrate this, Graham uses this really interesting metaphor, Mr. Market. Can you explain that one?
Sure. Picture this. Mr. Market is your business partner. Every single day, he comes to you, offering to buy or sell your shares. But here's the catch. His offers are based entirely on his current mood.
It sounds familiar, actually.
Right. So some days he's euphoric, sky high, wants to buy everything. Other days he's completely depressed, wants to sell it all off.
Okay.
The point is, the market often behaves irrationally. And your job as an intelligent investor is to recognize that. Don't get swept up in it. You don't have to buy or sell just because Mr. Market is having a good or bad day.
So how do we avoid getting caught up in, well, his mood swings? How do we stay rational when Mr. Market is being, well, Mr. Market?
That's where another key concept comes in. Margin of safety. No matter how amazing an investment seems, never pay full price.
What would that look like, practically speaking?
Okay, imagine this. You're analyzing a company. It's worth, say, $400 million. But because the market is undervaluing it, you can buy it for $80 million. That difference, that's your margin of safety. Even if you're a little off in your analysis, you're protected because you bought it at such a discount.
It's like a buffer, right?
Yeah, exactly.
That's powerful stuff. It seems like Graham really wants us to think like business owners, not just stock traders.
Absolutely. And speaking of ownership, that leads us to another big part of Graham's philosophy: dividend policy. He believed shareholders shouldn't just be passive, they should be active owners, holding management accountable.
That's not something you hear very often.
Right. But Graham was adamant about this. You have the right, he said, to question management, vote against directors, advocate for your interests. You own part of the company. Your voice matters.
That's empowering. Okay, so Graham also tackles some common investment myths. What about buy what you know? What's wrong with that?
Well, familiarity can breed overconfidence.
I can see that.
Right. Take, for example, employees investing heavily in their own company stock. It feels safe, familiar. But if the company goes under, they lose their jobs and their savings.
Double whammy. Ouch.
Yeah. So diversifying beyond your immediate circle, even if it feels less familiar, is key.
Got it. What about chasing the hottest sectors?
Ah, yes. The dot-com bubble. Anyone.
Who could forget? Everyone and their grandmother was pouring money into tech stocks. It didn't matter if the businesses were viable or not.
That was a classic case of market mania. Graham reminds us today's hottest sector can turn ice cold tomorrow.
So the intelligent investor stays focused, does the research, thinks independently, and doesn't get caught up in the hype.
And always remembers the margin of safety. That's the heart of it. Graham gives you the tools to make sound investment decisions no matter what the market is doing.
Which is why the intelligent investor is still so relevant. It cuts through the noise, offers timeless wisdom.
It's a powerful reminder that investing isn't about gambling or, chasing quick riches. It's about making calculated decisions, managing risk, building wealth over the long term.
And speaking of the long term, Graham really dives into market history in the book. He uses a whole century's worth of data to show how stock prices have, well, fluctuated over time.
He goes all the way back to 1871, covering everything from prices and earnings to dividends. That kind of long-term perspective really helps you grasp the cyclical nature of the market, how it's behaved over time.
Okay, so what did he learn from all that data? What insights does Graham offer about these market trends?
One of the biggest takeaways is that the market can swing wildly in both directions. He even predicted something similar to what happened in the late 60s, the market reaching what he called unprecedented heights, levels that couldn't be justified by traditional valuation methods.
And wasn't he also, skeptical about predicting these swings with any accuracy?
Absolutely. He believed trying to forecast market movements was, well, a fool's errand. He really emphasized focusing on what you can control, your own investment decisions, your portfolio strategy.
So how does an intelligent investor navigate a market that's prone to such dramatic ups and downs?
Well, Graham offers some very practical advice on portfolio construction, particularly for the defensive investor. He suggests a balanced approach, a mix of stocks and bonds.
And he was pretty specific about the proportions, wasn't he?
He recommended a minimum of 25% in bonds and a maximum of 75% in stocks, with, of course, the flexibility to adjust based on your risk tolerance and the current market conditions. He felt this balance provided stability and potential for growth.
Now, for bonds, Graham has some pretty clear guidelines. He talks about considering both taxable and tax-free bonds.
Right, and the decision of whether to go with taxable or tax-free bonds, it really comes down to simple arithmetic. Compare the difference in yields with your own tax bracket.
Yeah.
He even uses a really clear example with 20-year maturities.
So you're basically figuring out if the tax savings from a tax-free bond outweigh the potentially higher yield of a taxable bond.
Exactly. It's all about maximizing your after-tax return.
Makes sense.
And when it comes to choosing specific bonds, Graham recommends sticking with high-quality issues. Strong credit ratings,
Yeah.
the reliable ones.
He seemed to be a big fan of U.S. savings bonds, especially for the defensive investor.
They offered a great combination of safety, liquidity, and a guaranteed return, which was very appealing, especially in uncertain times.
Now, he also discusses other interesting bond types, like income bonds, for instance.
He found those fascinating. They had unique features that could benefit both the borrower and the lender. He even argued that income bonds were often a stronger choice than the more popular preferred stocks, which he considered inherently weaker.
It's so interesting how he challenges conventional wisdom, encourages critical thinking about every single aspect of a portfolio.
That's what makes him such a brilliant and enduring figure in the investment world. He cuts through all the hype and focuses on what truly matters.
Okay, let's shift gears a bit. Let's talk about common stock analysis. How does Graham approach this crucial aspect of investing?
Well, for him, the ideal scenario is determining a stock's intrinsic value. Then compare that to its market price.
So you're basically trying to figure out what the stock is actually worth, like its true value, versus what the market is currently pricing it at.
Exactly. And that's where it gets a bit, tricky. Because valuing a stock isn't an exact science. There's a lot of estimation involved, projections about the company's future earnings.
And Graham acknowledges that, right? I mean, he even talks about the limitations of purely mathematical approaches, especially when you're trying to value growth stocks.
He was very wary of relying too heavily on those future projections, especially if those projections were way different from the company's actual past performance. It made the valuations more susceptible to errors.
So it's about balancing that quantitative analysis, the numbers, with some qualitative judgment, right? Your gut feeling, a bit of intuition.
Absolutely. It's a bit of both. Graham gives you a framework to analyze a company's overall financial health, looking at profitability, stability, growth potential. But he also emphasizes you need to dig deep. Go beyond just the numbers on the financial statements. Understand the story behind them.
He illustrates this with some great real-world examples, too. I remember his analysis of, I think it was, 4 listed companies. He meticulously examines their financial performance.
Oh, yeah. That example really shows his principles in action. He walks you through how to evaluate a company's track record, its financial strength, its ability to weather those inevitable economic storms.
And he doesn't just throw out abstract concepts. He gives you practical advice on how to apply them, how to make real-world investment decisions.
He even shares specific ratios and metrics to use, remember, to assess a company's financial health, like the ratio of earnings to fixed charges. That helps you gauge if a company can actually meet its debt obligations.
He was incredibly thorough, from analyzing a company's debt structure to going through earnings reports line by line, searching for red flags, accounting gimmicks.
And always, circling back to that margin of safety. Even with a spot-on analysis, you need that cushion to protect yourself from unforeseen events, or even just errors in judgment.
Like a financial safety net. Okay, so Graham was also pretty clear about certain types of stocks intelligent investors should just steer clear of. What were some of those?
He was wary of new issues, those IPOs, especially the ones that were heavily promoted during those, super hyped bull markets. He found that they often turn out to be pretty poor long-term investments.
Yeah, it's easy to get caught up in the excitement of a hot new stock offering. But Graham reminds us to stay level-headed, stick to those core principles.
Absolutely. He also advised against investing in those highly speculative or glamour stocks, the ones that are driven more by hype and emotion, not solid fundamentals.
He had a great example of that. He talked about how investors are often drawn to companies simply because they're in a fashionable or trendy industry, the it industry of the moment.
He compared that allure of the industry of the future, as they call it, to something far less glamorous. Delivery trucks, succotash, and sloppy joes.
Okay. Interesting comparison.
Right. It's funny, but it makes a serious point. Don't let emotional biases cloud your judgment.
Focus on the underlying business, not just the shiny industry it's in.
Exactly. Another thing he cautioned against was relying too heavily on those stock recommendations you get from financial services or brokers, those hot tips.
Oh, yeah. Those?
He really believed you need to do your own independent research. Don't just blindly follow someone else's advice.
It's about empowering the individual investor to take control, make informed decisions. Now, Graham makes this distinction between what he calls defensive and enterprising investors. Can you explain that a bit?
Sure. He recognized that not all investors have the same amount of time, expertise, or even interest in actively managing their portfolios.
That's right. Jerks for different folks.
Exactly. So you have the defensive investor. They want a fairly hands-off approach, a simple, low-maintenance strategy that offers, a reasonable return with minimal risk.
And the enterprising investor is more, hands-on.
Yes. More willing to put in the time and effort. Dig deep. Analyze companies. Seek out those undervalued opportunities. Potentially higher returns, but also more risk involved.
And Graham provides specific guidance for both, right? Outlines different approaches to building a portfolio, choosing stocks.
He knew there's no one-size-fits-all. The key is choose a strategy that aligns with your goals, your temperament, your available resources.
So whether you're a hands-on investor or prefer a more laid-back approach, Graham offers valuable insights to help you navigate the market's, let's face it, sometimes very confusing complexities. So let's dive into his specific recommendations for each type of investor. Where do we begin?
Well, for the defensive investor, Graham suggests a core portfolio built around, those high-quality bonds we talked about, and a diversified selection of large, well-established companies. The blue chips.
Simplicity is key here, right?
Absolutely. Stick with investments you understand, nothing too complex or speculative.
He even suggests that for a lot of defensive investors, just dollar cost averaging into a low-cost index fund is an effective way to build a diversified portfolio. You don't even have to actively pick stocks.
That strategy aligns perfectly with Graham's philosophy. Minimize risk. Maximize those long-term returns.
Now, what about the enterprising investor? The one who's ready to roll up their sleeves and get their hands dirty.
For the enterprising investor, Graham suggests a more active approach. Encourages them to seek out those undervalued or bargain stocks.
He gives specific criteria to help identify those potential gems, too.
Right, he does. He says, look for companies with strong financials that are trading below their intrinsic value. That's key.
So you're basically looking for hidden opportunities that the market is overlooking.
Exactly. He even suggests looking for companies that are trading below their net working capital. That means you're essentially getting the company's assets for free.
Wow. The ultimate bargain hunter.
Right. But even for the enterprising investor, Graham emphasizes thorough research, diversification, and of course, never forget that margin of safety.
He always brings it back to that, always reminding us that even the most, well, brilliant analysis can be wrong. So protecting yourself from potential losses is crucial.
It is. And that brings us back to one of the most memorable and enduring concepts in The Intelligent Investor, the idea of Mr. Market.
Right. Our favorite manic-depressive business partner who shows up every day with wildly fluctuating offers.
Exactly. Graham uses this brilliant analogy to really drive home the point that emotions, they drive those market swings. And it's so important to be able to separate those emotional fluctuations from a company's true intrinsic worth.
So the intelligent investor, they don't get swept up in Mr. Market's mood swings. They use them to their advantage.
Exactly. If Mr. Market is being overly pessimistic, offering you a bargain price, you buy. If he's euphoric, offering a ridiculous price, you sell.
You're basically using his irrationality against him.
That's the beauty of Graham's approach. He turns conventional wisdom on its head, encourages investors to think independently.
In this concept, it really highlights how important emotional discipline is in investing.
Absolutely. One of the biggest risks to an investor, Graham recognized, isn't actually the market itself, it's their own emotions.
Fear and greed, they can lead to some really impulsive decisions that often backfire.
Exactly. And that's why the intelligent investor is as relevant today as it ever was. It provides that framework for making sound investment decisions, no matter what's happening in the market, no matter what emotions you're feeling.
It's a timeless guide to navigating those complexities and building wealth over the long term. And speaking of building wealth, Graham has some fascinating insights into, well, the relationship between shareholders and management, particularly when it comes to dividend policy.
He was such a strong advocate for shareholders taking a more active role in their investments. They shouldn't be passive bystanders, he argued. They should hold management accountable for their decisions.
He even suggests specific actions shareholders can take, make their voices heard, things like attending annual meetings, questioning management directly, even voting against directors they disagree with.
He truly believed that shareholders have a right to be informed and to be involved in the companies they own.
He even suggests that companies should appoint independent directors
Yeah.
to provide that objective perspective, advocate for shareholders' interests.
Which back then was a pretty radical idea, but it's become much more commonplace today.
Yeah, it speaks to Graham's commitment to transparency, accountability,
Yeah.
and corporate governance. Now, when it comes to the actual dividend policy itself, Graham had some pretty strong opinions.
Oh, he does. He was a big believer in the importance of dividends as a source of income, a measure of a company's financial health.
He even criticizes companies that hoard cash instead of distributing it to shareholders through dividends.
He felt that hoarding cash, it was almost like depriving shareholders of their rightful return on their investment. I mean, think about it. While excess cash just sits there with the company, it's not really doing much for the outside shareholder.
That's a perspective you don't hear very often these days. So many companies are focused on stock buybacks and other financial engineering strategies.
It's a good reminder that companies, they should prioritize the interests of their shareholders. And Graham was also critical of companies that overemphasize growth at the expense of dividends.
He felt that a healthy balance was essential. Growth should be sustainable and ultimately benefit shareholders, either through increased dividends or higher stock prices.
Exactly. It's not about growth for growth's sake. It's about creating value for the company's owners.
This all ties back to Graham's core philosophy, right? Investing is about owning a piece of a business, not just trading pieces of paper.
Exactly. He believed in understanding a company's underlying fundamentals, making decisions based on long-term value, not short-term market fluctuations.
So dividends are a key part of that long-term value creation, a tangible return on your investment, a sign that the company is sharing its profits with its owners.
Right, and they provide that sense of stability, income, which can be especially valuable during times of market volatility, those turbulent times.
Now, one of the most powerful concepts in The Intelligent Investor, and we've touched on it already, is this idea of margin of safety. Can we unpack that a bit more?
Sure, so margin of safety, it's essentially the difference between what you pay for an investment and its intrinsic value, that gap.
So if you buy a company worth $100 per share, but you get it for $50 per share, that $50 difference, that's your margin of safety.
Exactly. It's like a built-in cushion to protect you from potential losses.
And Graham believed this margin of safety was, well, absolutely crucial, didn't he?
He did, because It accounts for the possibility that your analysis could be wrong, or that some unforeseen event could happen, something that negatively impacts a company's value.
It's about managing risk,
Mhm.
protecting your capital.
Exactly. He even says that the margin of safety is like the central concept of investment.
Without it, you're speculating, not investing. You're gambling that your analysis is perfect, that nothing unexpected will happen.
And we all know the market is full of surprises. He even says that margin of safety is, think of it this way, it's the difference between the percentage rate of earnings on the stock at the price you pay for it and the rate of interest on bonds.
Okay, so if you are buying a stock that yields 9% in earnings, but bonds are only yielding 4%, that 5% difference, that's your margin of safety.
That's how he frames it. And he points out that this margin of safety, it can absorb negative developments that might impact the company's future earnings.
Like a buffer, right?
Exactly, a buffer. And Graham emphasizes the bigger your margin of safety, the lower your risk. He always advocated for buying those undervalued assets. And he believed that margin of safety was key to minimizing losses and maximizing those long-term returns.
This whole approach, it really makes sense. It's not about trying to perfectly time the market or chasing the latest, hot stock. It's about making calculated decisions based on solid fundamentals, protecting your capital from those potential losses.
It's about thinking like a business owner, not a gambler.
Now, Graham also acknowledges that margin of safety, it can be difficult to quantify, especially in today's market, where valuations can be driven by factors beyond those traditional metrics.
That's true. He pointed out that back in his day, there was typically a larger gap between the earnings yield on stocks and the interest rate on bonds, which provided a more substantial margin of safety.
But he also emphasizes that even in a market where that gap is narrower, that principle of margin of safety remains absolutely crucial.
It does. It's about being disciplined, avoiding those overpriced assets, and focusing on investments where the potential reward, it outweighs the risk.
And that's a timeless lesson, really, something every investor can benefit from. Now, to really illustrate the importance of this margin of safety, Graham shares some pretty, striking examples of what can happen when you overpay for an investment. Can you give us one of those?
Sure. He uses this very simple scenario to get the point across. Imagine you find this stock, you're convinced it's going to grow at 10% per year, even though the overall market is only growing at 5%. Sounds pretty good, right?
Definitely. You're beating the market, outperforming. What's the catch?
The catch is you're so excited about the stock, you overpay. And it ends up losing 50% of its value in the first year. Even if the stock then goes on to generate, double the market's return, it'll take you over 16 years just to break even.
Wow, 16 years. That's a long time to be in the red.
All because of that initial loss from overpaying. He even offers another example where a stock is purchased at such an inflated price that even with a robust 10% annual return, it would take over 43 years to break even.
43 years. That's a lifetime.
It is, and it really drives home the point that patience and discipline, they're just as important as picking the right stocks.
I see that. It's not just about finding those winners. It's about managing your entry point, not letting your excitement get the best of you.
And Graham reminds us that risk isn't just out there in the market, it's also within ourselves. He has this great quote. He says, if you want to know what risk really is, go to the nearest bathroom and step up to the mirror. That's risk, gazing back at you from the glass.
Okay, that's a powerful image. What does he mean by that?
He's saying that our own biases, emotions, misjudgments, they can be just as dangerous as any external market force. Overestimating our understanding of an investment or our ability to stomach losses that can really set us up for trouble.
So self-awareness is key to being an intelligent investor. Knowing your strengths and weaknesses is just as important as analyzing a company's financials.
That's right. And Graham even draws a parallel between investing and, remember Pascal's wager from philosophy class?
Vaguely. Something about the existence of God.
Right. Pascal argued that it's more rational to believe in God because the potential consequences of being wrong are much greater if you don't believe.
Okay, so how does that apply to investing?
Graham suggests we apply similar logic to our investment decisions. The probability of us making at least one mistake over our investing lifetime, it's practically 100%. We can't control that.
But we can control how we respond to those mistakes.
Exactly. We can control the consequences of being wrong. By focusing on margin of safety, diversification, and avoiding that excessive risk, we're essentially hedging our bets. just like Pascal argued.
So even if some of our investments don't pan out, we've protected ourselves from those catastrophic losses.
Precisely. And that's really the essence of Graham's approach. It's not about being right all the time. It's about managing risk, maximizing your chances of success over the long term.
He provides that framework for making those rational decisions, even in the face of uncertainty and those inevitable mistakes.
And that's why The Intelligent Investor remains such a timeless classic. It's not just a book about investing, it's a book about making wise decisions in all aspects of life.
It's about understanding ourselves, our biases, our limitations, and then making choices that align with our long-term goals and values.
And that's a message that really resonates. It's about taking responsibility for our own financial well-being, making choices that empower us to achieve our dreams.
So for all you deep divers out there, if you're looking for a guide to navigate those market complexities and build wealth over the long term, I highly recommend The Intelligent Investor. It's full of timeless wisdom, practical advice that can help you make smarter decisions and achieve your financial goals.
And remember, investing isn't about gambling or chasing quick riches. It's about making those calculated decisions, managing risk, building a solid foundation for your financial future.
That's great advice. Until next time, keep diving deep, and remember, the intelligent investor is always learning, adapting, and striving to make the most of their opportunities. Okay, so we've talked about how important this whole idea of margin of safety is, but how do we actually find those opportunities? The ones where we can really get that built-in safety net. What does Graham suggest?
Well, he really emphasizes focusing on value investing. It's all about finding those companies that are, for whatever reason, currently undervalued by the market.
Okay, so find the bargains. Got it. But how do you actually figure out if a company is truly undervalued? I mean, it's not always obvious, right?
Right. And that's where the real work comes in. Graham offers a whole bunch of tools and techniques you can use to analyze those financial statements, assess the intrinsic value of a company. He looks at earnings, assets, dividends, the whole picture.
So it's more than just looking for a cheap stock.
It is. You have to dig deeper. Look beyond the hype, the headlines, and really understand those numbers.
And that's where those metrics and ratios he talks about come in, right?
Exactly. He gives you specific things to look at, to evaluate a company's financial health, see how it compares to its current market price. And he also talks about the importance of looking at track records, long-term prospects. Is this company built to last?
So it's not just about finding a company that's on sale right now. It's about finding a company that's fundamentally sound and poised for future growth.
You got it. And that takes, well, it takes effort, careful analysis, a willingness to really do your homework. Now, Graham also talks a lot about diversification. Why is that so important for the intelligent investor?
Well, I know the saying, don't put all your eggs in one basket, right?
Exactly. Diversification is all about spreading your risk across different types of investments. So if one investment doesn't do so well, the others can help cushion the blow.
So you're not putting all your hopes on one single stock.
Right. And Graham takes it even further. He says diversification should go beyond just owning different stocks. Think about bonds, real estate, other asset classes.
Well, a truly diversified portfolio could include, like, stocks, bonds, maybe even some rental properties or something.
Exactly. The goal is to create a portfolio that can weather different market conditions. And of course, diversification goes hand in hand with that margin of safety.
Right, because if one investment takes a hit, the others can help soften the landing.
And it helps you emotionally, too. Reduces that temptation to, panic sell when the market inevitably dips.
That emotional discipline is something Graham talks about a lot, isn't it?
Yeah.
It's not enough to have a good strategy on paper. You have to actually have the mental fortitude to stick to it, even when things get, well, a bit scary.
He calls it having the courage of your convictions. It's about trusting your analysis, not getting swept up in the fear and greed that drives those market swings.
So it sounds like The Intelligent Investor isn't just a guide to picking stocks. It's almost like a guide to developing a mindset for success in the market.
That's a great way to put it. Graham gives you that framework for making rational, disciplined decisions, even when the market is, well, being completely irrational.
And that's a skill that's valuable, not just for investing, but for, well, pretty much everything in life, right?
Absolutely. It's about taking that long-term perspective, thinking for yourself, not letting your emotions cloud your judgment. Important stuff.
Well, I think we've covered a lot of ground today, done a pretty thorough deep dive into The Intelligent Investor. Any final thoughts you'd like to leave our listeners with?
Just to reiterate, Graham's work, it's as relevant today as it ever was. His principles, value investing, that margin of safety, emotional discipline, they're timeless.
And anyone can apply them, no matter how much experience they have or how much money they're working with.
Exactly. The intelligent investor, it's not just for financial professionals. It's for anyone who wants to take control of their financial future, build wealth over time.
So to our listeners, if you haven't already, I really encourage you to pick up a copy of the book, give it a read. You'll be surprised how much wisdom you can find in those pages.
And remember, becoming an intelligent investor, it's a journey. It's a lifelong pursuit, really. There's always something new to learn, new opportunities to explore.
That's a great note to end on. Thanks for joining me on this deep dive. Until next time, keep diving deep. And remember, the intelligent investor is always learning, adapting, and striving to make the most of those opportunities.